Good morning. My name's Richard Divall. I'm based in London. As I've been described, I head up our cross-border capital markets team for the EMEA region, but I'm also helping our clients in the EMEA region go into and enter the Americas and APAC. Thank you very much for having me. This morning, I thought I'd talk quickly on some of the major trends that are happening, how much capital's been raised, where it's going, why it's going, and also some of these capital sources, and then bring it back to our region and how this might benefit this region. Having someone from London, I thought it's very difficult to ignore Brexit, which obviously we're all very bored of from around the world, but particularly in the UK. But there are geopolitical issues that does affect capital flows and does affect investment strategies. And whether this is the US-China trade war, whether it's Germany potentially going in recession, whether it's Southern Europe requiring further quantitative easing, or whether it's the Hong Kong politics or Brexit, it really is having an effect on investors' strategies. Brexit is causing a real headache around the EMEA region and for globally. You know, we're seeing institutional money requires more certainty. So actually, the depth of the market in the UK is very small. We're seeing investment volumes decrease by about 45%. However, we are seeing family office money from around the world, seeing it as an opportune time with the currency play, but also with institutional money sitting on the beaches, not being able to invest, really believing in London being a truly global city and taking a longer-term view. With the lack of depth in the market, we are seeing some activity. We do hope by October the 31st there will be more certainty. We hope there will be a deal. A deal is good for everyone. However, we don't want a bad deal. So hopefully Boris has shut Parliament in the UK, and that's really to keep up his negotiating positions. As it's commonly known, the EU may negotiate at the final minute. First of all, I just want to talk about volumes from a global regional perspective. So this first slide shows that 1.75 trillion US dollars is being invested in real estate. There is far more money that's actually being raised for real estate, and it's 30% more than back before the global financial crisis. And this is really, in this low interest rate environment, infrastructure and real estate really is appealing for people to try and get higher returns. So we're seeing more and more money wanting to get into real estate, wanting to cross borders, wanting to invest in different regions and countries, and how that's going to benefit. When we look at each region, the yellow line in this chart shows that APAC has actually had a huge boost in the last couple of years, and that's really been the China effect. All markets are benefiting in Asia Pacific from the China effect. The Americas and the EMEA capital flows are generally quite correlated together. We are seeing a bit of an upturn in Americas at the moment and a bit of a downturn in the EMEA region. And that's mainly because the UK, one of the biggest markets in our region, is obviously really well down on investment volumes. So which cities are really, really benefiting from this global capital? And this first slide shows between 2008 and 2013, the top 20 global cities, with obviously the big cities like New York and Tokyo and London and Paris, etc., really benefiting. But it's all quite close how much capital flows were going in. But as we move forward, between 2008 and 2019, we're obviously seeing these tier one global cities really take away and expand and receive more capital flows in that. And mainly that's because they offer large available equity checks. And investors who have raised so much money for real estate, who quite often want to deploy 300 million plus into one transaction, are finding it more difficult to do that apart from the Tier 1 global cities. When we look at the global cities around the world, the dark blue is North American money crossing borders. The light blue is APAC money, and the yellows is EMEA money. So really this slide, what it's really showing us is that in the US, the big cities are very domesticated. There's a lot more North American money going into them. However, when you come to the big three cities of Europe, London, Berlin, and Paris, although the majority is still coming from the EMEA region, London, for example, is very heavily dependent on money coming in from APAC, but also from North America. And when we go into the Asian Tier 1 cities, again, it's really domesticated, but there is more and more money coming from the Americas and coming from EMEA into those regions. And which sectors are really benefiting? So with this weight, unprecedented weight of capital, effectively all sectors have benefited from this global capital flows. We've seen offices increase 40% between 2010 and 2018. We've actually seen retail increase by 44%. However, in the last 12 months, and I'll touch on this a bit later, we are seeing retail go negative as it restructures itself. But as retail shrinks, industrial and logistic grows, and there's a lot of momentum in those sectors as e-commerce takes an effect and industrial fundamentals really improve. But the real momentum is in what we're calling the alternative property sectors, what we call cradle to grave, which is education, student housing, co-living, senior living. And these sectors are all supported by very strong demographics, again, which I'll touch on towards the end of this presentation. But residential is finally becoming institutionally acceptable as a property sector, and we're seeing a lot of money going into residential. We're seeing more money going into hotels. But the bottom, the real momentum, and I know they're coming off lower bases than the traditional sectors, is development sites. And this is because this weight of capital has really driven down yields in all markets to record low prices, that probably 75% of all capital targeting the EMEA region is looking for value-add, build-to-core strategies. And that really is improving the income of assets or redeveloping to hit the latest trends of mixed-use development or urban logistics, etc. I now really want to talk on which country, where this capital is coming, where it's going, and finally, which sectors are benefiting. I've got to go through at least 14 countries in probably about 10 minutes, so some of them I will be a bit short, so I hope I don't offend anyone. But it's just to give you that flavor of where their money is going. The first, South Korea. South Korea is making a huge noise, particularly in Europe. Originally, South Korea, before the global financial crisis, was very much into development and was looking at developing countries like Poland, and I believe there was quite a bit of activity in the Middle East. Since the global financial crisis, the government has really forced the South Korean insurance companies and real estate businesses to look more safe and secure. And they've got a huge 100 basis points currency advantage in Europe against the euro, and they've had a currency advantage against the sterling. And we're really seeing them invest heavily into core offices, logistics, and now hotels, very income-driven. But we've seen them buy in London, we've seen them buy in Germany. They've spent 5 billion in La Défense in Paris this year, and now we're seeing that money move to Southern Europe, moving to, they've had success in Bratislava, moving to the Nordic region. What's interesting, because it's a currency play in Europe, it's actually a debt play in North America, and that's because of the strength of the dollar and where interest rates are. So I think the South Korean money will look at this region. However, it might come through the debt route depending on the currency play. But 80% of all money that's raised in South Korea has to go offshore, and they only have Seoul to invest in. There's no second cities. Japan. Everyone's talking about the Japanese money, and it's finally coming. The actual UK construction companies are very US, UK, Australia-centric. But the big pension funds, so GPIF, the Government Property Income Fund, it's never invested in real estate. It's always had a very safe, secure investment strategy, buying government bonds, buying major corporate bonds. It's now talking about investing 65 billion over the next 10 years into real estate, into infrastructure, as they've got an aging population and the pension deficit's lower. These funds, including Japan Post, they will go fund into funds, and they will be going throughout the world, but of course in a very cautious, logical manner. Singapore. Singapore is investing globally. The big players, the Maple Trees, the Keppel Capitals, the CapitaLands. Again, the UK is very attractive for their family offices. They're very familiar, as is Australia. However, those bigger players, which are generally backed by Temasek, the Singapore government, are looking to go all throughout the world. They are at different stages of their journey. Maple Tree arrived in the UK over 4 years ago. It's now bought in countries like Poland. It's bought pan-European and pan-US logistic portfolios. CapitaLand and Keppel are more at their start of the journey. Keppel has bought a large student housing platform in the US, and they're going to bring that to Europe. So I think some of that money will eventually come to this region, but it's at different stages, and someone like a Maple Tree will probably arrive here first. Malaysia. I always like to go to Malaysia. They have more political issues than the UK, so it's always a good conversation. But their pension funds are really not investing as much at the moment. They've got new teams. They're getting over the corruption that's been in the past few years. But they are starting to show their heads, but not deploying as much capital. Very focused at the moment on logistics, student housing, those sectors. China, so PRC, People's Republic of China. Obviously, in the last couple of years, they've had the capital controls, which has really restricted outbound flows. But probably in the last 2-3 weeks, I've had more inquiries from Chinese capital than I have in the last 2-3 years. They have been net sellers. Some of the state insurance countries like Anbang did buy quite poorly and are being forced to sell. However, we are going to see the Chinese come back with a different strategy. They won't be buying trophy hotels. They won't be buying football clubs. They'll be more likely to follow the Premier's One Belt, One Road strategy. So we are seeing Colliers is working with a Chinese state company at the moment who bought the port of in Athens, in Greece, and is working a train line up into Budapest that's going to give it access into Europe. So there is activity there. I believe Chinese capital is inquiring to try and buy land, which it can't get in Europe generally, in this region. So I think very much logistics, business parks, senior living, very important to Chinese. You will see that money come to this region. Hong Kong, it's very, very family office money. It is very London-centric. Some of it does go to the US, but really what's interesting here is how much is being repatriated in China. So 61.4 billion has been repatriated there. But the Hong Kong money probably is looking at those tier one global cities. They're not necessarily made their money from real estate, but they want to buy real estate. We obviously saw money come in and buy the cheese grater in London, buy the walkie-talkie. So maybe the Hong Kong money may not come here as quickly as we hope. Australia, we always joke that we must be at the top of the market cycle if the Australians are appearing again. So Australia, they've learned their lessons like the Japanese of buying badly in the last cycles. And this time they've set up a new vehicle called IPFM, which we've been working with for 18 months. And that is going to look after all the super fund money out of Australia. It's probably going to target the European Tier 1 markets. They're currently fundraising at the moment and are likely to be active in Q1 2020. That money eventually in the next few years, once it understands the market more, but they are setting up offices in Europe, and we can see that money expanding around the region. The US. So the US has obviously been very focused on the distressed market in Europe. And, you know, we are seeing that money sort of lower its horizons as we are at a mature part of the cycle. The new 15 to 20% returns has reduced more to 8 to 12% returns. But they're looking at buying platforms. Blackstone have just raised 20 billion for their latest European fund. How do they deploy that money when there's a real lack of products and quality buildings? And they've just spent 6.5 billion buying Dream Global REIT from Canada. That's the only way that large investors can deploy large sums, is by platform deals. But we are seeing them make a push into Asia. We're working with Cerberus over in Japan and China. And, you know, I can see some of that money looking at this region and coming here over the next couple of years. The Canadians. So the Canadian pension funds have been very active. The first tranche of them have been looking how to go global. They've had great success in the UK, they've had success in Paris, they've had success in Germany. Some of them have broadened their horizons into Central and Eastern Europe. They are certainly making a big push into jurisdictions like India for logistics, Australia for large platform deals, and Singapore. But we saw this week that Brookfield, the largest investment manager from Canada and the world, has come to this region for the second time. So I really do think once that large investor comes here, the more Canadian capital will be coming to this region. And then looking at some of the GCC countries, where they've been going, what they've been doing. So if you look at Bahrain, there's been a lot of money over the last 12 months that's been going to the US. Some money going to China, a tiny bit to the UK, and some to UAE. Kuwait, a lot of money again going to the US, some going to the UK, some looking at Canada, some looking at the Netherlands, and some looking at Singapore. Kale Street Partners, which is backed by the Kuwait Sovereign Wealth Fund, has just raised $3.5 billion to target assets all around Europe. So that increase in capital flows will increase. And then from Saudi Arabia, UK has been more favored, probably to do with the familiarity, yields getting a bit higher, more attractive, but more money going to the US, some money going to Italy, one of the late recovery markets of Europe, and some in France, and some also in Jersey. UAE, again, very US focused, very UK focused from across border, but looking at India. So India is starting to get attention from this institutional money and from money from this region. So a global flows summary. Effectively, this slide is really showing us what the Americans, Canadians, what the GCC, and what the Asia-Pac money, which sectors it's been buying. In yellow means they've been looking at offices. So Americans and Canadians have generally been buying offices. They've been buying retail. They've been buying logistics. And they've been buying residential. GCC money generally has been buying offices, hotels, and residential. Asia money has been buying offices, retail, and logistics, but we're starting to see them go into those alternative property sectors. Everyone in Europe has a currency advantage. However, the Asian capital is often getting a higher net yield in this region than they do in their own markets. Prime yields in Tokyo, Singapore, Hong Kong are often sub 3%. So this region is looking attractive from a net yield, whereas we're seeing the North American money and the money from the GCC paying often lower yields than they can get in their region, but using that currency advantage to effects. So I wanted to sort of bring it back and talk about demographics, because I think these are very important for this region, the demographic story. On the left, all the countries around Europe in green are showing a very positive, in generally, demographics. This is what's leading the capital going for these alternative property sectors. But the trouble about Europe is it's actually an aging population. It's only the UK in Western Europe that has a positive forecast for its working population. So how does Germany, France, etc., really work out how they can increase their working population with an aging population, putting more pressure on pensions and facilities, etc.? But when we come back to this region, the demographics is really positive, not just from an aging population, but from a working population, and that is key. This is what investors look at. It's one of the main reasons. Infrastructure, transparencies of markets, availability of big lot sizes, the property fundamentals, but really what's driving that? What are the demographics like? And I think this really positive speech for this region of having a really growing, working, young, talented population will really benefit capital flows to come to this region. So I just wanted to really finish on some trends that we're generally seeing throughout the world. So we're seeing a lot of investors take advantage of the currency advantage, particularly in Europe. The weak sterling. So the sterling, I remember in 2007, I used to get $2 to the pound. We're down to about 120, 125. There's talk that it might go as low as 110 when we understand on the 31st of October. But there are people sitting there waiting to see when that currency drops before coming back in. We're in this low rate environment. We haven't been in low rates for such a long time. It means finance costs are very low. You can get all-in finance costs in Germany at sometimes below 1%, which is why paying 3% in those markets is still very attractive. And they are talking that yield compression might still come. Investors are looking for mixed-use cities, smart cities, the new words. They want cities that have fantastic infrastructure, fantastic amenities for the talented young. And Dubai is definitely one of those cities. And those smart cities is where more capital will go in the future. I've touched on alternatives being very favorable, the alternative property sectors, the cradle to grave. There's a lot more money going in there. It will be interesting to see exit strategies and how that works. There are areas of distress around the world, and that's attracting capital flows in. Obviously, we've talked on Brexit, but there's still a lot of pockets of distress in places like Spain, in Greece, and that's attracting those opportunistic investors to try and get in early before those markets recover. There is a lack of development. Since the global financial crisis, banks have been more nervous to lend on speculative development. When you look at the key markets of Germany, all those 7 cities generally have office vacancy levels below 2%. They haven't been building. And this is leading to genuine rental growth in a lot of markets. And rental growth is key. That is what the investors really, really want to get their returns. They realize you can't bank on any more yield compression. You can in pockets in certain sectors like retail. However, it's really how do I drive that rental growth and how do I get my return for my investors? And then I just wanted to really just finish on retail, because retail is a big topic. I've mentioned that it's shrinking. You know, each market is different to each. In the UK, we built too much retail. We have retailers who are allowed to go into voluntary redundancy and turn around to the landlord and say, I'm only going to pay you 50% rent. It's causing a huge valuation issue. Buyers who may be interested in retail want to pay one price. Sellers still think they can get that price. But I think, you know, we are getting over the worst of it in parts. The UK is the most advanced e-commerce market in the world. We're currently 22% consumption in e-commerce, and there's talk that that will peak at probably 25 to 30%. However, we've already seen the grocery stores actually peak at 7.2%. So we're starting to see that American opportunistic money, German institutional money setting up grocery-specific funds. So it is counter-cyclical. I've been in many meetings with GIC in Singapore inquiring about retail. We've just seen Brookfield come here this week and buy into retail. So it isn't negative, it's just you've really got to understand what you're doing. So I think my time's up. So thank you very much. I'm very honored to speak to you all. I hope you found that informative.
Fantastic. Richard Divall from Colliers International, many thanks for that very comprehensive presentation. Do we have any questions from the audience? If you have any questions, just do let us know, raise your hand. But perhaps I can ask you, Richard, you just mentioned the Brookfield coming into this market in Dubai and with the partnership with Morass. Can you see more, North American companies coming in and doing more partnerships in the future?
Yes, I certainly can. I mean, Brookfield, for those who don't know, they are the largest investment manager in the world. They are bigger than Blackstone. And I think when you see someone like Brookfield come to this region, it will open the eyes of everyone else. Why have Brookfield come into this region? What am I missing? So I really do see quite a lot of North American money in particular seeing what Brookfield have done and probably coming to this region. Yeah.
Great. Thank you very much for that, Richard. Richard Divall from Colliers International. Thanks a lot.